This is my biggest mistake, is selling winners too early and holding losers too long. I sold Nvidia way too early. Breaking news on Martyn Lucas investor. Is a crash about to come? Well, we can never time the market, but we can get ready for the crash. This is the 6 mistakes wiping out retail investors in 2025. This is part of our newsletter from today. It's the first link in the description. We're talking about potential crashes. We've got tariffs coming up. We've got AI bubbles. We've got people saying crypto's too overvalued. We've got a lot of volatility, and we don't want to start timing the market, but we want to be prepared for it. So in today's deep dive, we talk about the psychology of market mistakes in a bubble era. We've got many mistakes people make, and mistakes I've made in the past, and mistakes many people have made. But if you haven't made them yet, please don't make these mistakes. And if you've made them before, don't make them again. Let me list those mistakes for you so you don't make them. So the reason we're talking about them now is valuations are stretched, momentum is narrow, and volatility is rising. With AI stocks driving most of S&P 500 gains and tariff headlines shaking sentiment, the market feels increasingly fragile. In these conditions, the difference between growing and losing capital often comes down to discipline. Below are 6 of the most common and most expensive mistakes active investors make, backed by data and practical ways to avoid them. I'm not making these up. I'm going to give you the statistics. This applies to the stock market. This applies to the crypto market. This applies to leverage trading. This applies to anything investing wise. So please do take notes of these. Please do understand them properly. Please don't make these mistakes. I want everyone watching this video, any member, any subscriber, any viewer, to make money. I don't want anyone losing money, and these mistakes can help you a lot. Again, I never give financial advice, but these are statistics. So 97% of day traders lose money. That's the statistic. Get your head over it, understand it, and what we're talking about here. So the striking figure comes from a detailed academic study by Brazil's Sao Paulo School of Economics titled Day Trading for a Living. Remember, we've seen the statistics everywhere. Some people say 95, 97, 90, 99. The figures there. Let me explain exactly how not to fall into this category, because it's very hard to be that 1%. So the researchers tracked nearly 20,000 retail future traders. Remember, these are retail futures traders on Brazil's main exchange over several years to see exactly who made money. The results were brutal. After 300 days trading, remember, this is over the long term. This isn't just one person coming in, making a trade and then leaving. This is people that were consistently learning, consistently trading. After 300 days of trading, 97% of traders had lost money. 97% of traders lost money. And only 1% consistently earned profit. Barely enough to beat Brazil's minimum wage. The study found that transaction costs, slippage, emotional trading decisions quickly compounded losses, making it almost impossible for frequent short-term traders to sustain gains. In short, the 97% figure isn't just an internet myth. It's based on hard data showing that most day traders, especially in fast-moving futures markets, lose over time due to structural and psychological disadvantages. This is the futures market. This is leverage trading. Let me just, someone's tried to call me. Let me, excuse me, I don't know why that came through. So this is leverage trading. This is the futures market. It's incredibly risky. This applies to leverage trading as well. If you're trading with leverage 1x, 2x, day in, day out, not just a long-term position with a little bit of leverage, that's a bit different. If you're day trading every single day with leverage on the futures market, with options, with calls, just stop. Don't do it. Give up. You're going to be the 97% in most scenarios, unless, and the only way to do it is to go onto an account that's funded, that's fake funded, like a lot of these places do it. Don't use your real money until you can prove to yourself that you are profitable for at least 3 or 4 months. Then get into the market and do it. And then you have to have a trading journal. You have to understand the risk. You have to understand all sorts. But for most people, like 99% of people watching this video right now, don't leverage trade, don't futures trade. You will become the 97%. You will lose money. That is the hard truth. That is the statistical truth. Swing trading, it's still a bit risky, but if you're swing trading, which is what I do mostly, which is what I use my charts for, the reason I do charts is not because I want to do leverage positions every day, it's because I want to find good companies. So I look at the fundamentals, I look at them at good value levels, and then I buy them for a swing trade or for a long-term trade. The companies mostly I buy and the cryptos I mostly buy, I buy because I'm happy to hold them long-term, even if the trade doesn't go well. If I get liquidated, then holding long term means nothing, because you might think you're a long term holder, but if you get liquidated, you don't have that asset anymore. I do a little amount of leverage trading, but I do it on a separate account with about 5% of my total portfolio. It's a very, very small amount. And I got wiped out on Friday as well. So I'm not immune from it either. Not at all. So just leverage trading, futures trading, day trading with leverage, don't do it. 97% of people lose money. Leverage magnifies losses faster than gains. So leverage remains one of the most common ways retail accounts are wiped out. The United Kingdom Financial Conduct Authority reports that 82% of CFD traders lose money. So if you're on Trading 212 or on any exchange trying to do CFD leverage positions, 82% of you lose money. Don't do it. When markets look unstoppable, whether it's AI, semiconductors, or tariff-linked rallies, investors often borrow to enhance returns, but even small reversals can trigger forced liquidations or margin calls, erasing months of progress in hours. So you can see the percentage is lower in this case. This is sort of leverage trading. So if you're buying with leverage on a dip or stuff, it's much easier to get this one right than trading every single day with leverage. It's sort of a swing trade with leverage. It's easier to get this right. It's more likely you're in that 20%. But you need to control your emotions and everything like that. So again, it's for most people, don't leverage trade, don't CFD trade, even over more of a long-term period. Okay, let's go on to some. For most people, are probably not going to listen to me, but anyway, let's go to some more things not to do that could be more achievable by most people. So make sure you are subscribing. Make sure you have hit the like button. Leave me a comment down below. What lessons have you learned? Have you made money leverage trading, future trading? I want to know, are you part of the 1% or the 20%? Let me know in the comments. What mistakes have you made that you want other people to look out for? Also, what another mistake is just scammers. Nothing to do with you, but remember, people impersonate me, people impersonate Martyn, people will try and call you pretending they're your bank, people will try and call you pretending they're Coinbase. If it seems too good to be true, if someone's offering you rewards or asking you to move your finances, me and Martyn will never do that. In terms of Coinbase scams, people start calling you, pretending that they're Coinbase, and you need to act quickly, so they make you panic. And then they also start saying, give me the code that comes up on your screen, and that verifies that that's me. Essentially, you're giving them your two-factor authentication code. So don't fall for these scams. If a bank ever calls you, if Coinbase ever calls you, they shouldn't be calling you. You have to find a way to contact them. Go through the proper channels to contact them. That's always a red flag. If someone says move your funds around, that's a red flag. If someone asks for a code, that's a red flag. There's many red flags. Be very careful in this day and age. That's the most annoying way to lose money. Anyway. Retail investors buy the dip too early. This is something that we might fall into. Seems to be a market crash on the way, but the issue could be people could buy the dip too early. So retail traders often see early declines as opportunities, only to watch those dips turn into deeper sell-offs. In 2025, Saxo Bank reported that retail flows spiked during initial pullbacks, while institutions stayed cautious. So retail investors, the volume went up. The retail investors started to buy the dips very early. Institutions didn't. You need to act more like institutions. They buy close to the bottom. They don't buy too early. They don't wait for a 1%, 2% dip. They wait for a 20% dip and then buy big. So this premature dip buying has repeatedly led to drawdowns as structural risk or sentiment shifts extend losses. If you look at something like XRP, we were at $3.30. We went to $3.20. Someone said, I'm buying the dip. We went to $3.10. I'm buying the dip, $3. I'm buying the dip. We went all the way down to 80 cents on Binance and $1.50, $2. That's buying the dip. If you wait until buying at $1.50, $1.80, that's a dip in crypto. A dip in crypto is 30, 40%. A dip in the stock market is about 10, 20, 30%. A dip on an individual high-risk stock is about 50, 60, 70%. You can't just buy the dip every 2% it goes down. You run out of money and you won't actually take advantage of the drop. The fix is patience and scale. Enter in stages instead of committing full capital at once. And that's why I use the charts. That's why I love using the charts, because we've got these support levels. Again, the link to the Discord where I teach you all about charts is in the comment section below, or become an Electrum member and you can learn it through our Sunday live shows. I can see where the support is and I just ladder in with patience and ladder. And if I miss it, I miss it. But I don't want to be buying 2% dips on a stock, because I won't have any money to buy a more significant dip. So the fix is patience and scale. Enter in stages instead of committing full capital at once. Wait for confirmation, higher lows, rising volume, or technical reversals before adding size. Buying too early is often more expensive than waiting. Another one, FOMO-driven trades lead to higher losses. Everyone FOMOs. Try and control your emotions. Roughly 73% of retail traders admit, I'm sure there's more that don't admit to FOMO-driven trades. And these positions are associated with losses up to 65% larger than planned. Fear of missing out pushes investors to enter late after major moves when risk reward is least attractive. Remember that. We love people who FOMO because they'll be our exit liquidity when crypto goes up. But you don't want to be, I don't want anyone here to be, unfortunately that's the way it works. I don't like anyone losing money, but if I can choose who loses money, it's not the ones that are watching this video today. So FOMO. People buy in too late. They start buying in when everyone is talking about it. They start buying in when it's already too high. And the issue with that is the risk to reward is outweighed at that point. If XRP is at $7, $8, $5, what's the reward? If it's at $5, maybe you'll get 2x. If it's at $7, maybe 30% or something like that. But the risk is an 80-90% correction. Even at $3, the risk reward for XRP was not brilliant, because we went from 30 cents to $3. At 30 cents, at 50 cents, at 70 cents, the risk reward was much, much better. So be careful with these FOMOs, because you're using your emotion and you're getting in at quite a bad risk to reward level. The best defense is structure. Every trade should have a defined entry, stop, target before execution. Know when you're going to sell, know when you're going to buy, know when you're going to buy more, and all of those sorts of things. When a stock or sector surges, step back for 24 to 48 hours to reassess. If you find yourself reacting emotionally to social media or headlines, reduce size or step aside entirely. Take a break. The disposition effect, selling winners too early and holding losers too long. This is a big one, and I guarantee people have done this. This is a massive, massive loser for people, and it's so frustrating, because this is when retail investors choose the right stocks, they sell too early, and they look at it later and they go, wow, that could have made me generational wealth, or that could have made me a light amount of money. And then instead they start buying their losers, keep buying their losers as it goes down, and then they lose all their money. So behavioral finance studies show that investors tend to lock in small profits quickly while clinging on to losing positions. This is the issue. You take profits too early and you hold on to your losers. Terrible. Don't do it. Behavioral finance studies show that investors tend to lock in small profits quickly while clinging on to losing positions, a bias known as the disposition effect. It stems from loss aversion. The pain of losing outweighs the satisfaction of small gains. Counter this by systemizing exits. Trail profitable positions instead of closing them arbitrary. For underperforming trades, set predefined loss thresholds and adhere to them. Regularly review positions with no clear catalyst for recovery and reallocate capitals to stronger setups. So essentially, this is like most people do it. You buy a basket of goods and your Tesla position, and you've got Tesla, Nvidia, SPCE, for example, over the last 5 years. Tesla goes up 10%. You sell a little bit, it goes up another 20% because you're like, I want to lock in these profits. I want to be a successful trader. You lock in those profits. Nvidia goes up 10, 20%, you sell it. And you've locked in those profits waiting for your next position. Then you've got SPCE, which has gone down 20%, you buy in. It goes down another 20%, you buy in. So you've done the other one, which is you buy the dip too early. And then SPC goes down another 50%, and then you buy more with additional funds. And then it goes down even more, and then you buy it. And then SPC goes down for 5 years. So I apologize, I'm using SPC as an example, but a lot of people know what I mean. SPC has been going down. This is a stock, high risk. goes down for 5 years. And what you've done is you've held on to your loser, which was in a downtrend. You've put all your money into a loser. You've been adding to the losing stock while Tesla's gone up 500%, while Nvidia's got up 1,500% or 2,000%. So what you've done is you've sold your winners too early. You've bought your losers, and you've been keep buying the losers on dips because you thought that's the dip to buy on. That's the dip to buy on. Do not sell your winners early because those are the ones that are going to earn you money. And if you've got a losing position, if it doesn't have the stronger fundamentals, if it doesn't seem to be in an uptrend, don't keep pouring money into it. You've got your position, hold your position. If it drops 50%, maybe add more. If it drops another 50%, don't buy the dip too early, and don't focus on your losers. Focus on your winners, because those are the ones that are probably going to make you money. So that's a very, very important one. Panic selling locks in permanent losses. So again, the final one here is when a crash comes, people are going to panic sell, and that's probably not going to be the best idea, especially on their winning stock. So during sharp market declines, many investors exit at the worst possible moment. That's called panic selling. Lots of people did it on the last tariff crash. What we did was the opposite. We bought big. Martyn bought big live on the show. We were talking about the technicals and how this is a point to be buying. So during sharp market declines, many investors exit at the worst possible moment. A 2022 MIT study on investor behavior found that panic sellers tend to underperform by roughly 9% over the following year, missing the eventual rebound. Because when you panic sell, when are you going to buy back in? Firstly, the emotion means that you're fearful, and when the market's fearful, the market normally bottoms. So first of all, you're probably selling near a bottom. Secondly, when are you going to buy back in? If you're already panicking, the market's probably not going to go down too much more, and then you have the issue of buying back in. So that's why you tend to underperform. Prevent starting long position before a sell-off. So again, you can understand how to sort that out yourself. So in overheated markets, discipline becomes a competitive advantage. If you want to win, if you want to beat everyone else, you have to be disciplined. Every major correction from 2000 to 2008 to 2022 has punished overconfidence more than ignorance. The investors who keep their gains are rarely those who predict the top. Remember, what does Martyn always say that we love? It's making money is the easy part. Keeping it is the hard part. So it's important to hold on to that money as well. So the investors who keep their gains are rarely those who predict the top, but those who manage risk when the crowd forgets to. So I really, really hope that people take some notes and people learn, because too many people, especially people that are in crypto, that are in high risk stocks, forget about all these basic rules that can turn you from being someone who's losing money, someone who's not making the gains they should, to a very profitable and long-term investor and making the right decision. So I really do hope at least one of those points helps you. I would take notes of all of those points I made. That's all from our newsletter. Do check out the newsletter. First link in the description. There'll be 2 videos here for you to look at. But until next time, take care of yourselves and each other.